Let me tell you something that might shock the investment world. While everyone else is racing to buy every artificial intelligence stock they can get their hands on, I have been doing the exact opposite. I have been selling, and not just small amounts. We are talking about billions of dollars worth of stock that I have liquidated over the past year and a half. People think I have lost my mind. They say Warren Buffett does not understand technology. They claim I am too old to recognize the future when I see it. But here is what they do not understand. I have been watching manias unfold for more than 7 decades now. I have seen the nifty 50 craze of the 1970s. I watched the dot-com bubble inflate and explode in spectacular fashion around the turn of the millennium. I witnessed the housing bubble that nearly brought down the entire financial system in 2008. And now I am watching artificial intelligence mania grip the markets with the same feverish intensity that preceded every single one of those disasters. Let me be absolutely clear about something. I am not saying artificial intelligence is worthless. Far from it. When my friend Bill Gates showed me ChatGPT for the first time, I was genuinely amazed by what it could do. The technology has read every book ever written. It can translate the Constitution into Spanish in 1 second. The amount of time it could save you if you were doing all kinds of things is absolutely unbelievable. But being amazed by technology and being willing to pay any price for it are two completely different things. And that distinction is what has made me rich while so many other investors have gone broke chasing the next big thing. You see, there is something I learned from my mentor, Benjamin Graham, that has guided every investment decision I have made since I was in my early 20s. He taught me that the stock market is a voting machine in the short run, but a weighing machine in the long run. In the short run, popularity contests determine prices. But eventually, reality catches up with everyone. Right now, the artificial intelligence sector is in the popularity contest phase. Stocks are being bid up not because of what they actually earn, but because of what people hope they might earn someday. And that hope has pushed valuations to levels that I can only describe as dangerous. Let me give you some concrete numbers. The S&P 500 is currently trading at a price-to-earnings ratio that is 53% higher than its long-term average going back to the 1950s. The cyclically adjusted price-to-earnings ratio, what many people call the Shiller-Cape ratio, is sitting above 37. That is a level we have only seen twice before in history, once right before the dot-com crash and once right before the Great Depression. When I see numbers like that, I do not get excited about buying. I get excited about selling. That is exactly what we have been doing at Berkshire Hathaway. In 2024 alone, we sold $134 billion worth of stocks and bought only $9 billion worth. That is a net selling position of $125 billion in a single year. We have never done anything like that before in the history of our company. And the selling has continued into 2025. Our cash reserves have now grown to more than $340 billion. That is more than double what we had just 2 years ago. It is more cash than Apple, Amazon, Alphabet, and Microsoft have combined. Some people look at that pile of cash and think I have lost my nerve. They think I have become too cautious in my old age. But what they do not understand is that cash is a weapon. It is the ammunition that allows you to act decisively when everyone else is panicking. The opportunities I have capitalized on throughout my career, investing in Goldman Sachs during the 2008 crisis, buying Bank of America when everyone was terrified, loading up on American Express when the salad oil scandal drove down its stock, none of those would have been possible without having cash ready to deploy. Now, I want to address the elephant in the room. Yes, I sold a massive amount of Apple stock. And yes, Apple has been one of my best investments ever. Tim Cook has made Berkshire more money than I have ever made Berkshire. I have said publicly that Apple is probably the best business I know in the world. But there is a difference between loving a business and being willing to hold an unlimited amount of it regardless of price. At its peak, Apple represented almost half of our entire equity portfolio. That is concentration that made even me uncomfortable. And with capital gains tax rates potentially going up in the future, it made sense to realize some of those gains now rather than later. So we sold in the second and third quarters of 2024 alone. We unloaded roughly 489 million shares of Apple. We kept selling into 2025. Apple is still our largest holding, but instead of representing nearly half our portfolio, it now represents about 21%. That is a much healthier allocation. But here is the thing that might surprise you. Even as I have been selling most of my American stocks, I have been buying aggressively in a place most investors completely ignore: Japan. Back in 2019, we started quietly buying shares in 5 major Japanese trading companies: Itochu, Marubeni, Mitsubishi, Mitsui, and Sumitomo. These are massive conglomerates that own interests in everything from energy and metals to food and textiles. They are essentially the Japanese versions of Berkshire Hathaway. When I first started buying, I was genuinely confounded by the opportunity. Here were these large, diversified, well-managed companies trading at what I thought were ridiculous prices, especially compared to the interest rates prevailing at that time. The dividends alone were attractive, and the buyback programs were adding to shareholder value every quarter. We kept buying quietly for more than a year before we announced our positions on my 90th birthday in 2020. Since then, we have continued to add to our stakes. As of early 2025, we own between 8.5% and 10% of each of these 5 companies. Our total investment cost was about $13.8 billion, and the market value of those holdings has grown to more than $23 billion. That is not bad for a position most people thought was crazy when we made it. And here is the beautiful part. We negotiated with each of these companies to relax the original 10% ownership ceiling we had agreed to. Over time, you will likely see Berkshire's ownership of all 5 increase even further. I have told Greg Abel, my successor, as CEO, that these are holdings we plan to keep for many decades, perhaps forever. Why Japan when everyone else is chasing artificial intelligence in Silicon Valley? Let me explain. These Japanese trading houses have several characteristics I love. First, they are diversified across many different industries, which reduces risk. Second, they have excellent management teams that prioritize shareholder returns. They increase dividends when appropriate, they repurchase shares when it makes sense to do so, and their top executives are far less aggressive in their compensation than their American counterparts. Third, they were trading at valuations that gave us a significant margin of safety. And here is something that might surprise you. Because Japanese interest rates have been so low, we have been able to borrow in yen at extremely attractive rates. We then use those yen to buy shares in these Japanese companies, which pay dividends that exceed our borrowing costs. We are essentially getting paid to hold these positions while we wait for their intrinsic value to be recognized by the market. That is the kind of mathematical certainty I like in an investment. Not the pie in the sky hopes that artificial intelligence stocks are priced on today. But Japan is not the only place I have been putting money to work. Let me tell you about some of the other positions we have been building while everyone else was distracted by the artificial intelligence frenzy. In October of 2025, we announced our largest deal in years, the acquisition of OxyChem from Occidental Petroleum for $9.7 billion in cash. This is the chemical business that produces chlorine, sodium hydroxide, and vinyl products used in everything from water pipes to medical supplies. Now, you might wonder why I would buy a chemical business when artificial intelligence is supposedly transforming the world. The answer is simple. Chemical businesses make actual money. They produce actual products that people actually need. They are not dependent on hopes and dreams and projections about what might happen in 5 or 10 years. OxyChem brings in more than $1 billion in pre-tax income annually. It has stable, predictable cash flows from products that have been essential to civilization for more than a century. That is the kind of business I understand. That is the kind of business I can value with confidence. The OxyChem deal also helps Occidental Petroleum, a company where we already own more than 28% of the stock. They are going to use $6.5 billion of the proceeds to pay down debt, which strengthens their balance sheet and makes our existing investment more valuable. Some analysts called this deal genius because it creates value on multiple fronts. We get a great business, Occidental gets a stronger financial position, and our existing stake in Occidental becomes worth more because the parent company is now on firmer footing. That is the kind of creative deal making that compound returns over time. But I have also been investing in much simpler businesses that most investors overlook entirely. Take Domino's Pizza, for example. We started buying shares in the third quarter of 2024 and have continued adding to our position ever since. We now own nearly 3 million shares worth more than $1 billion. Why pizza? Because Domino's has a dominant market position that competitors simply cannot replicate. As of 2024, Domino's accounted for about 1 in 4 pizzas delivered in the United States. While their closest competitors like Papa John's and Pizza Hut spent years closing stores, Domino's was building up its base. That is the kind of competitive moat I look for. The company has a strong international presence with robust growth potential in emerging markets. It has a business model that generates consistent cash flows regardless of whether artificial intelligence transforms the economy or not. People are going to keep ordering pizza. That I can predict with confidence. Then there is Constellation Brands, the beverage company that owns Corona, Modelo, and several popular wine labels. We bought about 5.6 million shares in the fourth quarter of 2024 for roughly $1.2 billion. This was our first significant investment in the alcohol industry, and some people were surprised by it. But think about the characteristics that make a great long-term investment. Strong brands that consumers are loyal to, pricing power that protects against inflation, distribution networks that competitors cannot easily replicate. Constellation has all of those things. The stock had fallen because of concerns about potential tariffs on Mexican imports and changing consumer trends toward lower alcohol consumption among younger people. But those are exactly the kind of short-term fears that create buying opportunities for patient investors. The fundamentals of the business remain strong, and over the long term, I expect Constellation to generate solid returns. I also added significantly to our position in VeriSign, the company that maintains the registry for all .com domain names. This might seem like a technology investment, but it is really more like owning a government-backed monopoly. The company has incredibly high profit margins, above 50%, and a business model that is essentially guaranteed to generate steady cash flows for as long as the internet exists. That is a very different proposition than betting on which artificial intelligence company might dominate a market that does not even exist yet. Now, let me explain my deeper concerns about the artificial intelligence mania that has gripped the stock market. When Bill Gates showed me ChatGPT, I told him something that I think is important. Artificial intelligence cannot do everything people hope it will do. It cannot tell me which stocks to buy. It can tell me every stock that meets certain criteria in 3 seconds, but it cannot make the judgment calls that separate great investors from mediocre ones. I asked Bill to bring it back when I could ask it how to get rid of the human race. I wanted to see what it would say and pulled the plug before it answered. That was a joke, of course, but it contained a serious point. We are releasing a genie from a bottle with artificial intelligence, and that genie scares the hell out of me. I do not know anything about artificial intelligence from a technical standpoint, but I do not need to understand the technology to understand human nature. I compared artificial intelligence to the invention of nuclear weapons, and I meant it. When we developed the atomic bomb during World War II, it was enormously important that we did so. But is it good for the next 200 years of the world that the ability to destroy everything has been unleashed? We are still living with the consequences of that decision, and we will live with them forever because you cannot uninvent something once it exists. The same is true for artificial intelligence. Once the genie is out of the bottle, there is no putting it back. Einstein said after the atomic bomb that it changed everything in the world except how men think. I would say something similar about artificial intelligence. It can change everything in the world except how men think and behave. And that is a big limitation. My biggest concern about artificial intelligence is not that it will take over the world in some science fiction scenario. My biggest concern is much more practical. I think artificial intelligence will make scamming the growth industry of all time. I actually saw an artificial intelligence generated video of myself online that was so realistic, even my family would not have recognized it as fake. I practically would have sent money to myself over in some crazy country based on that video. If artificial intelligence can fool my own family about whether something is really me speaking, imagine what it can do in the hands of criminals. Scamming has always been part of the American scene, but artificial intelligence gives criminals unprecedented tools to scale their operations, personalize their attacks, and automate their schemes. The barrier to entry for fraud is dropping while the potential damage is increasing exponentially. And what about jobs? Artificial intelligence can potentially create an enormous amount of leisure time by automating work that humans currently do. But what the world does with leisure time is another question entirely. John Maynard Keynes correctly predicted that output per capita would grow at an exponential rate, but he failed to predict what humans would do with increased productivity. I know an awful lot of people who think when they first go to work that what they want is leisure time, but what I like is actually having more problems to solve. I tap dance to work every day because I love what I do. Not everyone feels that way, and if artificial intelligence eliminates the work that gives meaning to people's lives, the consequences could be profound. My late partner, Charlie Munger, was even more skeptical than I am. He said he was personally skeptical of some of the hype that has gone into artificial intelligence. He thought old-fashioned intelligence works pretty well. That line got applause from our shareholders because it contained an important truth. The smartest people I know are not the ones using the most sophisticated technology. They are the ones asking the right questions and applying common sense to their answers. No amount of artificial intelligence can substitute for good judgment, ethical principles, and the wisdom that comes from decades of experience. So what should ordinary investors do in this environment? First, do not chase the artificial intelligence hype. The stocks that have been bid up the most are priced for perfection, and perfection rarely happens in the real world. When everyone is excited about something, that is usually the worst time to buy it. Second, focus on businesses you can understand. I have been investing for more than 70 years, and I still stay within my circle of competence. If I cannot figure out what a company will earn over the next 10 years, I do not invest in it, no matter how exciting the story sounds. Third, pay attention to valuation. The key to investing is not assessing how much an industry is going to affect society or how much it will grow. The key is determining the competitive advantage of any given company and, above all, the durability of that advantage. Then you have to pay a reasonable price for it. Fourth, have patience. The best opportunities come when everyone else is scared, not when everyone is excited. I would rather sit on cash earning treasury yields than overpay for stocks that might look brilliant today but disastrous in hindsight. Fifth, think like an owner, not a trader. When you buy a stock, you are buying a piece of a business. Ask yourself whether you would want to own that entire business at the current price. If the answer is no, do not buy even a small piece of it. The stocks I have been buying recently, Japanese trading houses, Domino's Pizza, Constellation Brands, OxyChem, VeriSign, they are not exciting by Wall Street standards. Nobody writes breathless articles about the pizza delivery revolution or the transformative potential of chlorine production. But these are businesses that generate real cash, have real competitive advantages, and trade at prices that make mathematical sense. That is how I have always invested, and that is how I will continue to invest until my last day on this earth. I announced in May of 2025 that I would step down as CEO of Berkshire Hathaway at the end of the year, handing the reins to Greg Abel. After 60 years of running this company, it is time to let a younger person take over the day-to-day operations. But I am not going anywhere. I will remain chairman of the board and continue to be involved in major decisions. And I want to leave the next generation with a clear message. Do not get caught up in manias. Do not pay any price for something just because it is popular. Do not confuse activity with accomplishment or excitement with returns. The principles that have made me successful are simple. Buy good businesses at fair prices. Hold them for the long term. Stay within your circle of competence. Keep a margin of safety. Have cash available when opportunities arise. These principles worked when I started investing in the 1940s. They worked through every crisis and boom and bust since then. And they will work long after artificial intelligence has either transformed the world or disappointed the people who paid too much for its promise. The market will continue to do what it has always done. Swing between fear and greed, between pessimism and euphoria. My job has always been to be greedy when others are fearful and fearful when others are greedy. Right now, with artificial intelligence stocks soaring and the broader market at historically elevated valuations, I am choosing to be fearful. I am sitting on the largest cash reserve in Berkshire's history. I am selling American stocks and buying Japanese ones. I am investing in pizza and beer and chemicals instead of chips and software. Some people think I have lost my touch. They think the world has changed in ways I cannot comprehend. They think artificial intelligence is different and that this time the rules of valuation do not apply. I have heard that before. I heard it about the Nifty 50. I heard it about dot-com stocks. I heard it about housing prices that could never go down. Every single time, the people who said this time is different were eventually proven wrong. And every single time, the patient investors who stuck to fundamentals came out ahead. I am betting that history will repeat itself once again, not because I am old-fashioned or technophobic or incapable of understanding change, but because I understand something more fundamental than any technology. I understand human nature, and human nature has not changed in thousands of years. People will always chase excitement. They will always convince themselves that this time is different. They will always pay too much for dreams and too little for reality. And patient investors who understand this will always have opportunities to profit from their mistakes. That is the lesson I want to leave for the next generation of investors. Not stock tips or market predictions or opinions about artificial intelligence. Just the simple truth that has guided my entire career. Value matters, price matters, patience matters, and no amount of technological change will ever make those principles obsolete. I have lived long enough to see many revolutions come and go. Television was going to change everything. The internet was going to change everything. Mobile phones were going to change everything. And they did change things in many important ways. But the companies that profited most were not always the ones that everyone expected. And the investors who made the most money were not the ones who chased the hype. They were the ones who stayed calm, did their homework, and waited for prices that made sense. That is what I am doing now, and that is what I recommend you do too. The artificial intelligence revolution may turn out to be everything its promoters claim, or it may turn out to be another example of expectations exceeding reality. Either way, the investors who pay too much today will regret it, and the investors who keep their heads will have plenty of opportunities to buy great businesses at reasonable prices. I have $340 billion in cash ready to deploy when those opportunities arrive. In the meantime, I am happy to earn treasury yields and wait, because in investing, as in so much of life, the most important quality is not intelligence or information or connections. It is temperament, the ability to stay calm when everyone around you is losing their minds, the ability to say no when everyone is saying yes, the ability to wait for your pitch instead of swinging at everything thrown your way. I have been practicing that temperament for 70 years, and I am not about to abandon it now, no matter how exciting artificial intelligence might seem. The future belongs to patient investors who understand value. It always has, and it always will. That is my message to you today. Take it or leave it. But remember, a decade from now, when we look back at this period, we will know which approach was right. I know where I am placing my bet. Let me take you back to where this all started for me. I was 11 years old when I bought my first stock. It was 1941, and I paid $38 for 3 shares of City Service Preferred. The stock dropped almost immediately after I bought it, and my sister Doris reminded me every day that I was losing her money because she had invested alongside me. I sold those shares when they recovered to $40, making a small profit. But the stock eventually went to $200. That early experience taught me two lessons that have stayed with me ever since. First, do not obsess over short-term price movements. Second, never sell a good business just because you are tired of waiting for it to perform. Those lessons are even more relevant today when artificial intelligence has created a casino atmosphere in the stock market. People are buying and selling based on millisecond price movements and algorithmic predictions. They have forgotten that behind every stock is an actual business with actual employees and actual products and actual customers. When I look at the artificial intelligence sector today, I see companies trading at valuations that assume they will dominate industries that do not even exist yet. They are priced for perfection in a world where perfection never happens. One bad quarter, one regulatory setback, one competitive threat, and those valuations can collapse overnight. I have seen it happen before. In 1999, everyone was convinced that the internet would change everything and that traditional valuation metrics no longer applied. Companies with no earnings and questionable business models were valued at billions of dollars simply because they had .com in their names. I was criticized relentlessly during that period. People said I was a dinosaur who did not understand the new economy. They said I was missing out on the opportunity of a lifetime. They said my value investing approach was obsolete. Then the bubble burst. The NASDAQ fell nearly 80% from its peak. Trillions of dollars in paper. Wealth evaporated. Companies that had been valued at billions went bankrupt. And the people who had mocked my caution suddenly wanted to know how to invest like Warren Buffett. I am seeing the same pattern now with artificial intelligence, the same breathless predictions about how everything is different this time, the same disregard for traditional valuation metrics, the same certainty that anyone who does not embrace the revolution is a fool. History may not repeat exactly, but it certainly rhymes. And the tune I am hearing today sounds very familiar. Let me tell you about my philosophy on technology investing more broadly. And people think I do not understand technology, but that is not quite right. What I do not understand is how to predict which technology companies will win in highly competitive, rapidly changing markets. Think about the automobile industry. When cars were first invented, there were more than 2,000 auto manufacturers in America. Most investors at the time could see that automobiles would transform society. They were absolutely right about that. But knowing that automobiles would change the world did not tell you which automobile company to invest in. Most of those 2,000 companies went bankrupt. The same thing happened with airplanes. I have joked that if a capitalist had been present at Kitty Hawk when the Wright brothers made their first flight, he should have shot down Orville Wright. It would have been an act of mercy for future investors. The airline industry has destroyed more wealth than it has created over its entire history because of brutal competition and thin profit margins. Artificial intelligence might be different, or it might not. The technology will certainly change many things about how we live and work. But knowing that does not tell you which companies will profit from those changes or what prices you should pay for their stocks today. I prefer to invest in businesses where I can predict with reasonable confidence what they will look like in 10 or 20 years. Coca-Cola will still be selling beverages. American Express will still be processing payments. Apple will still have customers who love its products. Those predictions might not be exciting, but they give me a foundation for rational valuation. With artificial intelligence companies, I cannot make those predictions with any confidence. Which models will be dominant? What will pricing look like? How will regulation affect the industry? What competitive dynamics will emerge? There are too many unknowns for me to feel comfortable making large bets. That is why I've been focusing my attention on more predictable opportunities. Let me tell you more about why I love the Japanese trading companies so much. These businesses have been around for more than a century. Mitsubishi was founded in 1870. Mitsui traces its origins back to 1673. These are not speculative bets on unproven technologies. These are established conglomerates with demonstrated track records of creating shareholder value over generations. The trading companies control vast networks of businesses spanning multiple industries and geographies. Mitsubishi owns everything from copper mines in Chile to convenience stores across Japan. Mitsui has stakes in hospitals in Asia and automotive companies in North America. Itochu owns Family Mart, the second largest convenience store chain in Japan. When I first started researching these companies, I was amazed by how cheap they were trading relative to their underlying assets and earnings. The market was essentially ignoring the value of their diversified business portfolios because investors preferred more focused pure-play companies. But diversification is exactly what I want in uncertain times. If artificial intelligence destroys some industries and creates others, a diversified conglomerate will have exposure to both sides of that transformation. If commodity prices spike due to geopolitical tensions, the trading company's resource investments will benefit. If Japan's economy recovers from decades of stagnation, their domestic businesses will flourish. I do not need to predict exactly which scenario will unfold. I just need to know that I am paying a reasonable price for a collection of assets that will retain and grow their value over time. The other thing I love about these Japanese companies is their approach to capital allocation. They increase dividends when earnings grow. They buy back shares when their stock is undervalued. They invest in their businesses when returns are attractive, and they do all of this while paying their executives a fraction of what American CEOs make. At Berkshire, we have always believed that executive compensation in America is out of control. CEOs make hundreds of times what their average workers earn, often regardless of how the company actually performs. Stock options create incentives for short-term thinking and accounting manipulation. Golden parachutes reward failure. The Japanese approach is different. Executives are paid well, but not extravagantly. Their compensation is tied more closely to long-term performance, and they maintain a sense of obligation to all stakeholders, not just shareholders. I admire that approach, even if it is not always reflected in stock prices. And when I find companies with excellent businesses and excellent management trading at excellent prices, I buy them. That is exactly what happened with the Japanese trading houses. Now let me explain my thinking on the consumer businesses I have been buying. Domino's Pizza might seem like an unusual investment for someone of my generation, but when I look at Domino's, I see a business with characteristics I have always loved. First, they have a dominant market position that competitors struggle to match. The pizza delivery business has powerful network effects. Domino's has invested heavily in technology, building delivery systems and ordering platforms that are hard to replicate. Their scale allows them to negotiate better prices with suppliers and spread fixed costs over more orders. Second, they have a franchise model that generates capital-light growth. Domino's does not need to invest billions of dollars to open new stores. Franchisees provide the capital and take on the operational risk, while Domino's collects royalties and supply chain fees. This creates high returns on invested capital and steady cash flows. Third, the product itself is remarkably consistent. A pizza in Tokyo tastes essentially the same as a pizza in New York. This consistency builds brand trust and makes international expansion much easier than for most restaurant concepts. Fourth, pizza is relatively recession resistant. When times are tough, people trade down from expensive restaurant meals to more affordable options like pizza delivery. Domino's actually does well during economic downturns because it represents value compared to alternatives. These characteristics create a durable competitive advantage, what I call an economic moat. And when I can buy a company with a wide moat at a reasonable price, I am happy to do so regardless of what artificial intelligence might or might not accomplish. Constellation Brands represents a similar opportunity in the beverage industry. The company owns Corona and Modelo, which are among the fastest growing beer brands in America. They also have a portfolio of wine and spirits brands that generate consistent cash flows. Beer is an interesting business because brand loyalty is extremely strong. Once people develop a preference for a particular brand, they tend to stick with it for decades. This creates pricing power and predictable demand that most industries would envy. The stock was trading at depressed levels when I bought it because of fears about potential tariffs on Mexican imports and concerns about younger consumers drinking less alcohol. But those are exactly the kind of short-term fears that create buying opportunities. Tariffs come and go with political cycles. Consumer preferences evolve but do not change overnight. The fundamental value of owning leading beer brands is not going to disappear because of temporary headwinds. I have been investing long enough to know that the best opportunities come when everyone else is worried about something. In 1976, I bought shares of Geico when the insurance company was on the verge of bankruptcy. Everyone thought I was crazy. That investment eventually became worth billions of dollars. In 2008, I invested in Goldman Sachs when the financial system was collapsing. I got preferred stock with an 8% dividend and warrants to buy common stock at a substantial discount. That investment generated billions in profits. The common thread in all of these investments is that I was buying when others were selling out of fear. I was willing to hold when others wanted to run away. And I was patient enough to wait for the value to be recognized by the market. That same patience is what I am applying to my current investments. The Japanese trading houses, the consumer brands, the chemical businesses, these are not exciting stocks that will double overnight, but they are solid businesses that will compound value over time. And when you can compound at reasonable rates for decades, the results are extraordinary. Let me share a story that illustrates why patience matters so much in investing. When I bought my first shares of Coca-Cola in 1988, the company had just introduced New Coke and then abandoned it in one of the biggest marketing disasters in corporate history. The stock was depressed, and many investors thought the brand had been permanently damaged. I looked at the situation differently. Yes, the company had made a mistake, but the underlying business was still incredibly powerful. Billions of people around the world had grown up drinking Coca-Cola. That emotional connection was not going to disappear because of one bad product launch. So I bought a lot. We eventually accumulated about 9% of the company at a cost of around $1.3 billion. That stake is now worth more than $25 billion, and we have collected more than $10 billion in dividends over the years. The key was patience. I did not buy Coca-Cola expecting the stock to double in 6 months. I bought it expecting the company to continue generating growing profits for decades, and that is exactly what happened. Artificial intelligence investors do not have that patience. They want their stocks to double this year, then double again next year. They are chasing growth rather than value, momentum rather than fundamentals. Some of them will get lucky, just as some .com investors got lucky by selling before the crash. But luck is not a sustainable investment strategy. Over time, the mathematical certainties of value investing will outperform the speculative hopes of momentum chasing. Let me talk about another aspect of my investment philosophy that is especially relevant today. I call it the newspaper test. Before I make any investment, I ask myself how I would feel if the details of that investment were published on the front page of my hometown newspaper. Would I be proud of it? Could I explain it to my neighbors in simple terms? Does it align with my values and principles? This test has kept me out of many investments that might have been profitable but did not feel right. I have never invested in tobacco companies, even though they have generated excellent returns over the years. I have avoided businesses whose success depends on exploiting their customers. I have stayed away from complex financial instruments that I do not fully understand. The newspaper test also applies to how I think about artificial intelligence. Yes, the technology could generate enormous profits for investors who get in early on the right companies, but at what cost? I mentioned earlier that I see artificial intelligence-powered scamming as the growth industry of all time. The same technology that can write beautiful poetry can also create convincing fraud. The same algorithms that can diagnose diseases can also manipulate elections. The same systems that can automate routine work can also put millions of people out of jobs. I am not saying these outcomes are certain. I am saying that when I think about the full picture of what artificial intelligence might mean for society, I am not comfortable rushing to profit from it without understanding the consequences. This brings me to a broader point about the role of business in society. Throughout my career, I have believed that businesses exist not just to make money for their shareholders, but to contribute to the communities where they operate. Berkshire Hathaway employs nearly 400,000 people. Those jobs support families, fund education, and strengthen local economies. When I invest in a company, I am not just buying a claim on future profits. I am becoming a partner in an enterprise that affects real people's lives. That responsibility weighs on me, and it should weigh on every investor. The artificial intelligence revolution will create winners and losers. Some businesses will be transformed for the better. Others will be destroyed. Some workers will find new opportunities. Others will lose their livelihoods. I am not naive about these realities, but I also believe that patient capital invested in businesses that create genuine value for customers and employees plays an important role in making capitalism work for everyone. The quick buck artists chasing artificial intelligence stocks are not thinking about these broader responsibilities. They just want to get rich fast and move on to the next hot thing. That is not how I invest, and it is not the legacy I want to leave behind. Speaking of legacies, let me tell you about my succession planning at Berkshire Hathaway. Greg Abel has been preparing to take over as CEO for years. He knows the company inside and out. He shares my values and my approach to investing. I have complete confidence that he will lead Berkshire successfully for decades to come. But I also want to be clear about something. The cash pile we have accumulated is not a problem to be solved. It is an asset to be deployed wisely. I hope Greg will have the patience to wait for the right opportunities rather than feeling pressure to put money to work just because it is there. Throughout my career, the best investments I have made came when I was patient enough to wait for exceptional opportunities rather than settling for mediocre ones. The worst investments came when I felt pressured to do something and lowered my standards. That discipline is especially important now when artificial intelligence mania has driven up valuations across the market. It might take months or even years for prices to return to levels that make sense. During that time, the pressure to invest the cash will be intense. But pressure is not a good reason to invest. The only good reason to invest is finding a business you understand at a price that gives you a margin of safety. Everything else is speculation. I have one more thought I want to share before I conclude. It is about the nature of wealth and what it means to be successful. I have been incredibly fortunate in my life. I was born in the right country at the right time with the right temperament for what I do. I have earned more money than any person could possibly spend in multiple lifetimes. I have received recognition and respect from people all over the world, but none of that would mean anything if I had compromised my principles along the way. The thing I am most proud of is not the money I have made. It is that I made it. Honestly, investing in businesses I believed in, treating partners and employees fairly, and contributing to causes I care about. When I eventually leave this world, my wealth will go to philanthropy. I have already committed to give away more than 99% of my fortune to charitable causes. The money will fund education, health care, and efforts to reduce inequality around the world. That is the real measure of a successful investment career. Not how much you accumulate, but how you accumulate it and what you do with it.
The artificial intelligence investors chasing quick riches today should ask themselves what kind of legacy they want to leave. Will they be proud of how they made their money?
Will they contribute something positive to society? Will they be able to look themselves in the mirror at the end of their careers? I hope so, because ultimately, that is what matters most. So to summarize everything I have shared today, I sold my artificial intelligence stocks because I believe they are overvalued and I cannot predict their future with confidence. I bought Japanese trading houses, consumer brands, and industrial businesses because they offer value, predictability, and durable competitive advantages. I am holding record amounts of cash because I want to be ready for opportunities that may emerge when the current mania ends. This approach might look foolish in the short term if artificial intelligence stocks continue to rise. But I am not investing for the short term. I'm investing for decades. And over decades, value always wins. That is the lesson I want to leave with you. Be patient, be disciplined, be skeptical of manias, and never forget that the stock market is there to serve you, not to instruct you. So thank you for listening. Now go out and invest wisely. I know where I am placing my bet, and I am comfortable with that choice. But let me share a few more thoughts that might help you understand my perspective even better. Throughout my career, I have noticed that the most dangerous words in investing are, "This time is different." Every generation of investors convinces themselves that the old rules no longer apply. They find sophisticated reasons why valuations do not matter anymore, why fundamentals are outdated, why this particular technology or trend justifies paying any price. In the 1920s, they said radio would change everything. And it did change many things. But Investors who paid ridiculous prices for radio stocks lost their shirts when the Great Depression hit. In the 1960s, they said the Nifty 50, those 50 supposedly invincible growth stocks, would grow forever. Investors paid 50, 60, even 100 times earnings for companies like Polaroid and Xerox. When the 1973 to 74 bear market hit, those stocks collapsed, and many never recovered their old highs. In the late 1990s, they said the internet would eliminate traditional business constraints. Revenue did not matter. Profits did not matter. Eyeballs and page views were the new metrics of value. We all know how that ended. And now, in the 2020s, they say artificial intelligence will transform everything so fundamentally that traditional valuation does not apply. Companies with no profits and murky business models are valued at tens of billions of dollars because of the magic letters A and I. I am not smart enough to know exactly when this mania will end, but I am experienced enough to know that it will end. All manias end. And when they do, the investors who paid the highest prices suffer the most. My approach has always been to avoid the mania altogether. Let other people fight over the hot stocks of the moment. I will buy the boring businesses that nobody is excited about at prices that give me a margin of safety and hold them for the long term. This approach requires a certain temperament. You have to be comfortable being wrong in the short term. You have to be comfortable looking foolish while everyone else is making money. You have to be comfortable with the loneliness of taking a different path. But here is what I have learned over 7 decades. The crowd is usually wrong at the extremes. When everyone is euphoric, bad times are usually ahead. When everyone is terrified, good times are usually ahead. The investor who can maintain equanimity, who can resist both the greed at the top and the fear at the bottom, has an enormous advantage over everyone else. That is what I am trying to do now.
The artificial intelligence euphoria is at or near its peak. The prices being paid for these stocks reflect assumptions that may or may not come true over the next decade or two.
Meanwhile, solid businesses and boring industries are being ignored because they are not exciting enough. I am buying the ignored businesses. I am selling the exciting ones. And I am holding an enormous amount of cash to take advantage of whatever opportunities the future might bring. Let me tell you about one more aspect of my investment process that I think is relevant to this discussion. I call it the punch card approach. Imagine that when you were born, you were given a punch card with only 20 slots. Each time you made an investment, you had to punch one of those slots. Once all 20 slots were punched, you could never make another investment for the rest of your life. If that were really the rule, you would think incredibly carefully about each investment. You would do exhaustive research. You would wait for the perfect opportunity. You would never make a casual bet on something you did not fully understand. That is how I try to invest, even though I do not actually have such a restriction. I act as if each investment matters enormously because over a lifetime, the big decisions really do matter enormously. The artificial intelligence investors I see today are the opposite of the punch card approach. They are making dozens of bets on companies they barely understand, hoping that one of them will be the next NVIDIA or the next Microsoft. They are treating the stock market like a lottery rather than a place to allocate capital to productive businesses. Some of them will get lucky, but most will not. And the ones who get lucky this time will probably give back their gains chasing the next mania after artificial intelligence. The punch card approach forces you to be patient and selective. It forces you to focus on quality rather than quantity. It forces you to think like an owner rather than a trader. That is the mindset I bring to every investment decision. And that is why I am comfortable sitting on the sidelines while the artificial intelligence frenzy plays out. Now, I want to address something that some people might be wondering. If I am so skeptical of artificial intelligence stocks, why did Berkshire buy shares of Alphabet, the company that owns Google? That is a fair question. Let me explain my thinking. First, we did not buy Alphabet because of artificial intelligence. We bought it because it is a great business at a reasonable price. Google search has one of the strongest competitive moats in the business world. Everyone needs search services, and Google has a clear and dominant lead. it would be nearly impossible for any challenger to catch up in the near term. Second, Alphabet has the characteristics I look for in any investment: high profit margins, strong cash flows, a management team that allocates capital intelligently, a balance sheet that can withstand any economic storm. Third, the price was attractive. Alphabet stock was negative for much of 2025 before starting to outperform the broader market. When we bought, the valuation was reasonable relative to the company's earnings power, not inflated like so many artificial intelligence stocks. Finally, and this is important, the Alphabet investment may have been made by one of my colleagues rather than by me directly. Ted Weschler and Todd Combs manage portions of Berkshire's portfolio and make their own investment decisions. They tend to be more comfortable with technology investments than I am. But regardless of who made the decision, Alphabet fits the Berkshire model because it is a great business at a reasonable price. We are not paying for artificial intelligence hype. We are paying for a dominant search franchise that generates enormous cash flows year after year. That is very different from the companies whose stock prices have been bid up purely on artificial intelligence hopes. Those companies need everything to go right to justify their current valuations. Alphabet would be a good investment even if artificial intelligence never amounted to anything. The distinction matters. I am not opposed to owning companies that benefit from artificial intelligence. I am opposed to paying prices that assume artificial intelligence will transform those companies in ways that may never materialize. Let me also say something about Berkshire Hathaway itself and how artificial intelligence might affect our operations. We own dozens of businesses, everything from insurance to railroads to candy companies to furniture stores. Many of these businesses are already using artificial intelligence in various ways. Our insurance companies use it to assess risk and detect fraud. Our manufacturing businesses use it to optimize production. Our retail businesses use it to manage inventory and personalize marketing. But we are not betting the company on artificial intelligence. We are not trying to become an artificial intelligence leader. We are simply using the technology as a tool to make our existing businesses more efficient. That is the sensible approach for most companies. Artificial intelligence is a tool, not a strategy. The companies that will win in the long run are the ones with the best products, the best services, the best customer relationships, and the best competitive positions. Artificial intelligence can help with all of those things, but it cannot substitute for them. The companies being valued at astronomical multiples because of artificial intelligence are betting that the technology itself will be the source of their competitive advantage. But technology commoditizes quickly. Today's breakthrough is tomorrow's table stakes. The companies that win are usually the ones that combine technology with other advantages that are harder to replicate. That is why I am comfortable owning businesses like See's Candies and Geico and the Burlington Northern Santa Fe Railroad. These businesses have advantages that do not depend on any particular technology. They have brands and customer relationships and physical assets that would take competitors decades to replicate. Artificial intelligence might make these businesses more efficient, but it cannot make them obsolete. And that is the kind of durability I want in my investments. I have been talking for a long time now, so let me try to bring everything together with some final thoughts. The world is going to change in the coming decades. Artificial intelligence will probably be part of that change, although exactly how remains uncertain. Some companies will benefit enormously. Others will be disrupted. Some workers will find new opportunities. Others will struggle to adapt. As investors, we cannot predict exactly how these changes will unfold, but we can control how we respond to them. We can maintain discipline and patience. We can focus on valuation and fundamentals. We can buy businesses we understand at prices that give us a margin of safety. We can resist the urge to chase every hot trend. That is the approach that has served me well for more than 70 years. I see no reason to abandon it now, even if artificial intelligence turns out to be everything its promoters claim. The principles of value investing are timeless. Buy good businesses, pay reasonable prices, hold for the long term, maintain a margin of safety, be greedy when others are fearful, and fearful when others are greedy. These principles worked when Benjamin Graham first articulated them nearly a century ago. They worked through every technological revolution since then. And they will work through whatever changes artificial intelligence brings. I am confident of that because these principles are based on human nature, which does not change. People will always chase exciting stories. They will always pay too much at peaks and sell too cheap at bottoms. They will always convince themselves that this time is different. And patient investors who understand this will always have opportunities to profit from their mistakes. That is my message to you today. Do not get caught up in the artificial intelligence mania. Do not pay any price for the promise of transformation. Do not abandon the timeless principles that have made generations of investors wealthy. Instead, focus on value. Focus on fundamentals. Focus on businesses you understand at prices that make sense. Focus on the long term rather than the next quarter. If you do these things, you will be fine regardless of what artificial intelligence does or does not accomplish. You will be building real wealth based on real businesses, generating real cash flows, and that is the only kind of wealth that endures. Thank you for taking the time to hear my thoughts. I hope they have been helpful. Now it is up to you to decide what to do with them. As for me, I'm going to keep doing what I have always done, buying great businesses at fair prices, holding them for the long term, accumulating cash when nothing looks attractive, and waiting patiently for the next opportunity to deploy that cash wisely. It is not the most exciting approach to investing, but it is the one that has made me rich. And more importantly, it is the one that has let me sleep well at night for more than 7 decades. That peace of mind is worth more than any amount of money, and I would not trade it for all the artificial intelligence stocks in the world.